Hi, my name is Kelsey Fenton, and I will be starting off today's discussion on the basic properties of stock options. In particular, Tim and I are going to be talking about covered call options. So a covered call option is when one sells a call option while simultaneously owning the obligated number of shares of underlying stock. Typically, to write a covered call option, it's issued for every 100 shares that you own. And the type of people that issue these covered call options typically are neutral or mildly bullish towards the underlying stock. This person I'm referring to is known as the writer. These writers who are bearish towards their stock should not write covered calls, and that's a topic we'll discuss later on. A pro of writing a covered call option is by writing a call against the stock, it decreases the risk of owning the stock. A con, however, is that writers may limit their profit potential since they're unable to fully participate in a strong upward move in the price of the underlying stock. Now, going off the last example we just talked about, if the XYZ increases in price moderately, the trader may be able to have the best of both worlds. Let's explain this with the following three scenarios. Scenario 1 we already went over. XYZ is at or just below 50 at July expiration. We said that the call would expire worthless and the investor only makes a small profit, his $300 premium, nothing extra. Now, however, in scenario 2, let's say XYZ increases in price by expiration to levels above 50. The writer will have two choices in this scenario. One, he can do nothing. The profits will equal 300, plus you'll earn a profit on the increase in stock from the purchase, from the $48 that you originally purchased it for to the sale price on your call that you established, which was $50. In this case, if he does nothing, his option would be assigned and called away, and he would no longer own that stock. And that's a very important concept. We'll talk about later whether or not you should take this option. If you see that there might be future profits for yourself, or you will be struggling with the fact of losing out on not being a shareholder anymore, this isn't recommended. A second choice that he would have is to retain stock ownership by buying back or covering the written call in the open market. By retaining stock ownership, the writer might take a loss on the option part of the covered writing transaction, but he would have a corresponding larger profit from his stock purchase. And again, he would retain his ownership. Now, in the third scenario, XYZ rises to a price of 60 at July expiration, which is 10 above what you originally established a call at of 50. So the call option would sell near its intrinsic value of 10. The investor will cover the call at 10. He loses $700 on the option portion of his covered right. This is calculated by taking the $300 premium that you got this from the sale of the option minus the $1,000 buyback value. There's an unrealized gain here because it went up to 60 from the $48 that you originally paid for the stock. So that's a 12-point unrealized gain. Your total profit, including realized and unrealized gains, would be $500. And that's calculated by taking $300 from the sale of the call plus the $200 from buying back the stock at 48 and selling it at 50. So now let's compare those three scenarios we just went over. The major difference between them, again, is if the stock is called away, the investor no longer owns the stock. But if he buys back the written call, like we showed at the end of scenario 2 and in scenario 3, the investor will retain his stock ownership. It isn't necessarily clear which one is better. Each of them have their own pros and cons. The pro of the stock being called away is that the investor would get the immediate cash flow of $300 and do whatever he pleases with it. A con of not buying back the call is that your profit is limited. No matter how high the stock climbs in price, the profit from a covered call is limited because the writer has obligated himself to sell stock at the striking price. Not to say he doesn't receive any profit, rather he will not profit as much as if he had not written the call. Here are just some important formulas that you should know relating to covered calls. The maximum profit potential is equal to the strike price minus the stock price plus the call price. And the downside break-even point is the stock price minus the call price. Now we can see that same example to XYZ July 50 call shown in a table. Graphically, all covered rights will look pretty similar to this. The maximum profit, where the line plateaus, always occurs when the stock price is equal to or greater than the striking price, which here is at 50. There is a downside risk to consider, however. You see where the line on the left goes below the horizontal line? If the stock declines in price past the $48 break-even price, the writer will experience a loss. Now let's just go over some basic covered writing philosophy. The main objective to covered writing is to increase income through stock ownership. This is achieved when the option premium acts as a partial compensation for a decline in price by the underlying stock, or when the premium represents an increase in income to the stockholder. let's get a general understanding of the strategy of covered writing. Every covered writer is hoping that by owning the stock and writing the call, that they will outperform outright stock ownership if the stock falls, remains the same, or even rises slightly. However, the only time an outright owner will outperform the covered writer is if the stock increases in price by a relatively substantial amount during the lifetime of the call. Why typically covered writers outperform just a main shareholder is because if one consistently writes call options against his stock, his portfolio will show less variability of results from quarter to quarter. One should not assume, however, that this will always be the case. Again, talking about how the price can increase by a substantial amount for the shareholder, stocks may make their gains in large spurts, and long-term gains on stocks have periods of large gains and large losses. Since the profit potential is limited for covered writes, we don't really participate in that. Now, when one issues a covered call, the typical scenario is that he or she would deposit the stock with a broker in a cash or margin account and write an option for each 100 shares owned. Remember, we said before that one call is typically 100 shares. Now, there are methods to avoid depositing stock with a brokerage firm. Typically, these brokerage firms charge commission, which we'll talk about later. And the first way you can avoid depositing with a brokerage firm is 1, depositing the stock with a bank, where the bank will issue an escrow receipt or letter of guarantee to a brokerage firm. Keep in mind, however, that this bank must be an approved bank in order for the brokerage firm to accept a letter of guarantee, and that not all firms accept a letter of guarantee. This can be expensive also because a new receipt or letter is required for each new option written. And it may not be worth it to the customer if they're only concerned with as little as 100 or 200 shares. It might just be better off you go with the commissions of a brokerage firm. Each individual should take that into account himself. And the second way that you can avoid depositing stock with the brokerage firm is depositing stock with a bank who is a member of the Depository Trust Corporation known as the DTC. The DTC works with the Options Clearing Corporation, who will deliver stock should an assignment notice be given to the call writer. This is typically the most convenient method for investors and the one that's most commonly used by institutional covered writing investors. There's usually no additional charge, and unfortunately though, only a limited number of banks are members of the DTC, and those who are members are typically larger banks located in the metropolitan centers, so it may be difficult for some individual investors to take advantage of this opportunity. So here's some examples of in-the-money and out-of-the-money covered writes. In this example, XYZ common stock is selling at 45, and 2 options are being considered for writing. The in-the-money write is July 40, and the out-of-money write is July 50. The XYZ July 40 is selling for 8. It offers 18% downside protection down to a price of 37, which is its break-even point, which you can see where the total profit is 0. Most in-the-money rights offer greater downside protection when compared to out-of-the-money rights. There's less risk, but this means that there will be lower reward potential, which can be seen as the max potential for this right is only $300 at any point above 40. The XYZ July 50 is selling for 1. This right only offers 1% of downside protection, but the max potential of $600 at any point above 50 is much higher than what we discussed previously with the in-the-money right. So it's more risky, but you can earn more. Now, the best way to compare these is look at what happens with each option between the stock at expiration between 40 and 50. The in-the-money option reaches its maximum profit. This is good for neutral or moderately bearish writers. The out-of-the-money option still requires the covered right to increase in price slightly to reach that maximum profit. It's a more aggressive position, but it's good for bearish writers. Now, one of the reasons why covered writing is used by many investors is because you can create a strategy to make a conservative covered right. Covered writing is generally a conservative strategy, but make sure you don't mix up writing a covered right on a conservative stock versus having the whole position be a conservative covered right. It's not the same thing. In a conservative covered right, the total position is conservative. You're not writing it on a stock itself being conservative. That's not required. Instead, you're going to make the whole scenario conservative. This offers reduced risk and good probability of making a profit. And the reason why it's a conservative strategy is because the covered writer always has less risk than a stockholder, provided that he holds the covered right until expiration of the written call. If the underlying stock declines, the covered writer will always offset part of his loss by the amount of option premium received, no matter how small. Remember before we were talking about the break-even point, how, once you get to that number, you can't really make any more losses. Now, remember, however, that investors cannot write a call on a stock that's too deeply in the money, because even though they would get large amounts of downside protection, their returns would be severely limited. One could have the same effect by leaving their money in a bank and receiving a nominal rate of profit, but a conservative covered writer strives to make potentially acceptable return while still receiving an above average amount of protection. Now here's an example of conservative covered writing. XYZ common stock is selling at 45 and XYZ July 40 call is selling at 8. The investment that's required to create this covered call is $4,500 to purchase the 100 shares minus the $800 received in option premiums, which brings that to $3,700. Your max profit potential in this is $300, and your potential return, you take the $300 divided by the $3,700 is around 8%. Now, remember that this is a July call, so it's not an entire fiscal year. So you can assume that since the call is being written at the beginning of July, that the potential return is greater than 10% for the entire year, which is great. Now, this right would provide 8 points of downside protection. There's no guarantee that such a return could actually be obtained. All that's certain is that the writer can make 8% in 9 months. Just be wary that there's no guarantee that 9 months from now, when the call expires, there will be an equivalent position to establish that will extend the same return for the remaining of the annualization period. This is only used for comparative purposes. The total position is an investment that will not lose money unless XYZ common stock falls by more than 8 points, or about 18%. And it's an investment that could return an equivalent of 10% annually should XYZ common stock rise, remain the same, or even fall by 5 points to 40. This is what makes it a conservative position. Now, remember that the stock may not be a conservative stock, but by writing this option, it has made the total position a conservative one. The only factor that would make XYZ not conservative is if it were so volatile that it could easily fall more than 8 points in 9 months. and we'll talk about volatility further on in the presentation. Now there's three basic elements that should be computed before entering into the position. The first is the return if exercised, the second is return if unchanged, and the third is the downside break-even point. And we're going to go into these in depth individually. First, the return if exercised. It's a return on investment that one would receive if the stock were called away. In an out-of-the-money covered right, it's necessary for the stock to rise in price in order for the return if exercised to be achieved. For an in-the-money covered right, the return of exercise is achieved even if the stock were unchanged at the price at expiration. When calculating the return if unchanged, it is the return that would be realized if the underlying stock were unchanged when the option expired. There's a fair comparison between in-the-money and out-of-the-money covered rights when using return if unchanged, which is great because no assumption is made concerning stock price movement. Finally, the downside break-even point is the percentage of downside protection that he would receive from selling the call, and it's directly related to the amount of risk assumed when writing the call. Now let's calculate those three parts that we talked about in a couple examples. We are considered writing a covered call on buying 500 XYZ common at 43 and selling 5 XYZ July 45 calls at 3. Now, before you do those three things we discussed before, first you need to compute your net investment required. You pay for the stock in full less the net proceeds from the sale of options, including all commissions necessary to establish the position. Now, the commission that's used here is an approximate since it varies from firm to firm, but you can see the stock cost plus your commission minus your option premium received plus an option sale commission gives you a net cash investment of $20,040, and this amount is going to be used in the further calculations. Step 2 is to compute the return if exercised. You take your stock sale proceeds, which were $22,500, less your commissions plus the dividends, less the net investment, which we just calculated before, and that gives your net profit if exercised of $2,945. Now, computing this in a percentage, you take the $2,945, divide it by your net investment that we calculated in the first step, and that gives you a return if exercised of 14.7%. In order to meet this return, the XYZ stock would have to rise in price from its current price of 43 to any price above 45 by expiration. It's important to compute the return if unchanged to see what the writer would receive if the stock price didn't rise to 45, which we'll talk about in step 3. Now here, the return if unchanged, you take your unchanged stock value, which was 500 shares at $43, plus your dividends minus the net investment, and that gives you your profit if unchanged of $1,960. Divide that by your net investment, which we calculated in step 1, and that's 9.8%. You can see here that stock sale commission is not included, and in the majority of cases, one would continue to hold the stock if it were unchanged and would write another call option against the stock, hoping to receive higher profits. Now in step 4, we'll compute the downside break-even point. If the stock were held to an expiration and the $500 in dividends were received, the writer would break even at a price of $39.08. You calculate that by taking your net investment minus your dividends. That gives your total stock cost to expiration, and you divide that by your number of shares you're holding. Again, commission is not included in this part of the calculation. Finally, in step 5, we're going to calculate our percent downside protection. You take the initial stock price minus that break-even point that was just calculated, and that gives you your points of protection, which in this example is $3.92. Now, divide that by your original stock price, and that gives you your percent of downside protection, which we said before was basically your risk. The lower amount of downside protection, the more risk the writer is taking on. You can use this percentage along with volatility to compare across stocks and see which is the best option for you to write a covered call on. Now let's do the same thing again in the second example. Assume the same facts, but instead this is a margin covered write instead of a cash covered write. Recall that the net investment for the cash write was $20,040. Margin covered writes cover less than half of the investment of a cash write when the margin is 50%, and this is a rate that's set by the Federal Reserve. In a margin account, one can remove the premium from the account immediately provided that he has enough reserve equity in the account to cover the purchase of the stock. So here we can take our stock cost plus the commissions, that gives your net stock cost, times that margin rate that we talked about, which is 50%, and the equity required is $10,758. Minus the premiums you receive, plus any commissions, that gives your net margin investment. Now, step 2 again, we'll compute the return if exercised, same concept, but we'll take the stock sale proceeds minus your commissions plus your dividends, less your margin interest charges, less the debit balance, less the net margin investment. That gives your net profit margin. You're going to take the net profit margin of $2,407 and divide that by your net margin investment, and that will give you your return if exercised. In this case, it's 25.9%. Remember, the example 1 return if exercised for writing a cash margin was 14.7%, which is usually, in the case of a margin, it will be higher than cash examples. For computing the return if unchanged, the only difference here is the subtraction of the margin interest charges from the profit. The higher the margin rate, provided that there is enough option premium to compensate for the main interest charges, you'll look at in the cash, it was 9.8% versus here it's 15.3% for the margin rate. That's calculated by taking your unchanged stock value plus your dividends, less your margin interest charges, less the debit balance, less the net investment margin, and that gives your net profit if unchanged. You're going to take that net profit if unchanged with the $1,422 and divide that by your net investment margin, and that gives you $9,283, which results in a 15.3% return if unchanged. Now let's compute the downside break-even point. We're going to take our net margin investment plus your debit balance, less your dividends, plus your margin interest charges, and that gives you your total stock cost at expiration. Again, same thing as the cash, we'll divide it by the number of shares held, and that gives you your break-even point of $40.16. In example number 2, for the margin, the $40.16 is higher than the cash, which was $39.08, because of the margin interest charges. Since the break-even point on margin is higher than on cash, there is a less % downside protection in a margin covered write, which we'll talk about in our next step. You take your initial stock price, less your break-even price, that gives you your points of protection. Again, divide by the original stock price, and in a margin call, it's only giving you 6.6% of margin downside protection. Remember that cash was 9.1%, which we said the less risky it is, the higher the downside protection you'll have. Now, as we were talking before, you would have heard me mention that in margin covered calls that there was monthly interest charges. These interest charges are typically applied to an account monthly, and it's calculated by taking the margin interest charges. It's equal to the debit, then you multiply that times 1 plus R, which is the interest rate per month, to the T, which is the number of months of expiration, minus 1. In this example, debit is $10,757 for 6 months with an interest rate of 10%. To calculate that, we're going to take the $10,757, multiply that by 1.1 to the sixth minus 1. And that gives you a monthly interest charge of $538. Now, the investor will pay this interest at the later stages of covered writing position, not only on the original debit, but on all previous monthly interest charges. Now let's look at the difference of a dime. Relatively small fractions can alter potential returns. Remember, the important aspects for potential returns were your prices of stock and the prices of the option. In this example, a 500 share covered write, if you look at the stock selling at 43 with a call at 3, the stock at $43.10 calling at 3, and $43.10 calling at $2.90. The break-even point didn't change by much, but potential returns are altered significantly. If one pays an extra dime for the stock and receives a dime less for the call, which is the far right-hand column, he may greatly negate the effects of writing against a large number of shares. Writing against 300 shares at those prices is approximately the same as writing against 500 shares if the stock costs $43.10 and the option brings in $2.90. So just keep this concept in mind when you're considering the prices of the stock and the option when you're writing your covered call. Now, to execute a covered write order, one may ask what should be done first, buy the stock or sell the option. Rather, instead of doing one or the other, it's best to have a simultaneous transaction of buying the stock and selling the option. It's the only way of assuring that both sides of the covered write are established at the desired price level. If one legs into the position, meaning that they do one or the other first, he or she is subjecting himself to risk. Now, one thing that a covered writer will typically do is establish a net position. Remember that the goal of a covered writer is to ensure that his net price is being obtained. This is known as the net covered writing order. It must be placed either directly with a brokerage firm's option desk or through the spread order entry for an online broker. And there's no guarantee that a net order will be filled. Now, to create a net position, an example is when the writer wants to buy stock at 43 and sell an option at 3, he is attempting to establish a net position at 40. It's important to make sure that your broker offers net orders, whether online or directly, through an order desk, aka a contingent order. Most major brokerage firms offer this service, but some place a minimum number of shares on the order. Also, it's not guaranteed that this net position will be met. It's a not held order, and the customer is not guaranteed an execution if it appears that the order could be filled at prevailing market bids and offers. The broker will attempt to fill the order if it can be reasonably accomplished. Now, you can get the same net price with different option prices, but it's not necessarily the same thing. Example 1, you buy a stock at $43.10 and you sell an option at $3.10. Your returns are very similar. There's no effect on that investment, but there may be an effect on commission. This small difference, however, would only be 0.1%, so it definitely isn't a make or break decision. Example 2 is if you buy stock at $40.50 and sell an option at $50, Your return if exercise remains constant, but your return if unchanged and percentage downside protection are reduced dramatically. Now in example 3, if you buy stock at 48 and sell the call at 8, you improve the return if unchanged and the percentage of downside protection. So now let's go over how to select a covered writing position. The writer must choose which stock to buy and which option to write, and there's importance on return on investment. Some considerations that we should look at is that there's a large number of stocks, striking prices, and expiration dates. You must keep in mind other facts like volatility, there's higher return but more risk, downside protection, quality, and technical fundamental outlook of the underlying stock. The primary objective here is to increase income through stock ownership. Now let's look at projected returns. It's the return that the writer strives for, and it's a matter of personal preference. The annualized return, if unchanged, should be used as the comparative measure between various covered rights. It removes the assumption about the stock moving up in price in order to attain that potential return. The general rule is 1% per month, but this may not be satisfactory for every writer, where some are only comfortable with 2% per month as the minimum return criterion. Even though it's higher, it's usually because they're taking on more risk, and it, again, is a matter of your personal preference. One should not be deluded into believing that he can always attain this projected annual return. For example, if there's a 6% return on a 6-month write, you should not assume that it will give you 12% return annually. It may be possible to achieve 6% in 6 months, but one does not really know for sure that in 6 months from now, there will be another position available that will provide 6% over the next 6 months. Now let's dive deeper into this downside protection we keep mentioning. It's more difficult to quantify than projected returns. It also can be misleading because more volatile stocks will always offer a large percentage of downside protection. We should instead use the percentage of downside protection and only consider rights that offer a certain level of protection. The standard is usually around 10%. For example, 10% protection on a volatile stock, is it better or worse than 6% protection on a less volatile stock? It's not really exact. It does strive to ensure that one has minimal downside protection on the covered right. There's pros and cons of each, and you as the investor should decide if the risk is worth the reward. Again, let's go back to the importance of strategy. There's a danger of using these fixed guidelines since market conditions are constantly changing. Let's look at the early days versus now. In the early days of listed options, premiums were so large that virtually every at or in the money covered right was satisfied in meeting the criteria, the 1% and the 10% that we talked about previously. Today, however, one should work with 2 ranked lists of covered writing positions. We should use these updated daily. One list is the annualized return as a minimum for downside protection level. And the second is the percentage of downside protection for stocks that meet the minimum acceptable return. These lists can be tailored to the writer's preferences, and this is known as the total return concept. In the money rights appeal to those investors looking to earn a relatively consistent moderate rate of return. Their concerns are preservation of capital, greater levels of downside protection, higher potential returns through on-the-money calls may be more aggressive to investors willing to accept more downside risk in their covered writing positions in exchange for possibility of higher returns should the underlying stock rise in price. There's an importance of looking at underlying stock itself. As long as one does not foresee a potential decline in the underlying stock, he can feel free to establish a covered writing position. Generally, it's best if one is neutral or slightly bullish in the underlying stock. If one, however, is bearish, he should not take a covered writing position on that stock, regardless of the levels of protection that can be obtained. One should not establish a covered writing stock that he doesn't want to own. Now, what should be included in your strategy? You should strive for a balance between acceptable returns and downside protection. You don't want to take too much risk and not have enough reward to offset that. You should also reject situations that do not meet the criteria. Reject stocks that are bearish, which we just talked about. Fulfill objectives of a conservative rating program. That's increased income, protection, and less variability of results. Writing against stock that's already owned, there's many reasons why this is done. One, investors feel that returns from writing are too low in comparison to other covered rights that simultaneously exist in the marketplace. Caution, however, this opinion may be valid, but often arises from the fact that investors have seen a computer-generated list showing returns on the stock being low in comparison to similarly priced stocks. These lists generally assume that stock is bought in order to establish a covered right, not computed and published for writing against a stock that's already held, so it is misleading. Second reason is commission costs for selling one stock and investing in another may alter returns substantially. One may be better off writing against the shares of stocks initially held. Caution, however, writing calls against stock already owned risk losing the stock via assignment. Writing calls against stock that you have no intention of selling is tantamount to writing naked calls. Now, for your portfolio, you should have established these fundamental diversification techniques. Recall that covered writing strategists would like to have a combination of high potential returns and adequate downside protection. Diversification can be achieved by writing a combination of out-of-the-money and in-the-money calls on stocks. There's no guarantee that writing this manner on a list of diversified stocks will produce superior results, and the individual investor may not have enough funds available to diversify into many such situations, so just keep that in mind. Writers may often do best by writing half its position against the in-the-money and half against the out-of-the-money on the same stock. So let's use those principles just established and looked at a combined right example. XYZ common stock at 42, he is looking to rate on a call of 40 and a call of 45 in April. He may like the protection afforded by the April 40 call, but he may not find the return particularly attractive. He may be able to improve his return by rating April 45s against part of his position. The best solution is the combined right, the best balance of return and protection. The in-the-money call provides over 11% of downside protection, but the 7.6% return if exercised is a bit more than 1% per month, meaning that the potential return is small. The April 45 would provide an attractive return if exercised, which is over 2% per month, but it only offers 7% of downside protection. Combined, however, it'll offer over 11% if the return if exercised, which is nearly 1.5% per month, and it affords over 8% of downside protection, which gives you the best of both worlds. It frees the covered writer from having to initially take a bearish approach on the in-the-money right or a bullish approach on the out-of-the-money right if he doesn't want to. Now let's look at this graphically. You can see above you have the out-of-the-money right, and below you have the in-the-money right. Right in between, best of both worlds, you have the combined right, and it'll most likely give you the best results. Other diversification techniques we should consider is that holders of large positions in a particular stock may want even more diversification than can be provided by writing against two different positions. Examples of people that do this are institutions, pension funds, and large individual stockholders. The solution here is to diversify writing over time, or at least two striking cases. Now let's look at this diversification example. you write a third of the position against near-term calls, a third of the position against middle-term calls, and a third of the position against long-term calls. The benefits of this is that one's position doesn't need to be adjusted over time. One is not subject to the level of option premiums that exist at the time one series of calls expires. And 3, this type of diversification may also lead to having calls at various striking prices as the market fluctuates cyclically. All of one stock in the third benefit is not necessarily committed at one price. That will conclude my section of Chapter 2, and I will be handing it off to Tim to finish out the chapter.
Establishing a covered right is only part of the strategist's job. Once position is taken, it must be monitored closely so that adjustments can be made as the written call approaches expiration. While some writers take no follow-up, this is not always the optimum option. Follow-up action can be divided into 3 general categories. 1. Protective action to take if the stock drops. 2. Aggressive action to take when the stock rises. Or 3. Action to avoid assignment if the time premium disappears from an in-the-money call. Protective action if the underlying stock declines in price. Covered riders that do not take protective action against drops in prices of the underlying stock risk substantial losses. These losses can potentially negate several winning positions. Typically, the rider in this situation would participate in a rolling down action. In a rolling down, the rider typically buys back the original call and then sells a call with a lower striking price. If you write covered writing position of buy XYZ at 51, sell the XYZ January 50 call at 6, this will give a maximum profit potential at expiration of 5 points with downside protection of 6 points to a stock price of 45 at expiration. The following option prices might exist: XYZ common 45, XYZ January 50 call 1, and XYZ January 45 call 4. This would lead to a small unrealized loss of 1 point in his overall position. If further stock price drop is anticipated, additional downside protection can be obtained by rolling down. If the rider were to buy back the January 50 call at 1 and sell the January 45 at 4, he would be actively rolling down. This would increase his protection by 3 points, causing his downside break-even to change to 42 after this roll down. Rolling down provides both protection against further drops in prices and may increase your profit if prices stabilize. In order to get a more exact evaluation of the overall effect of rolling down, one could either compute a profit table or draw a net profit graph that compares the original right to the rolled down position. Notice how the rolled down position has a lower maximum potential profit than the original position. This is because rolling down to a January 45 call limits his profits anywhere above 45 at expiration. In other words, they committed to sell the stock 5 points lower than the original position. Essentially, you are trading potential profit for additional downside protection. In more complicated situations, there may be a locked-in loss. This can occur with sudden and fairly steep declines in the price of the underlying stock. A locked-in loss means there is no option to which the rider can roll down that will provide him with enough premium to realize any profit if the stock was called at expiration. While rolling down would essentially guarantee a loss, it still may be beneficial to roll down and mitigate losses rather than waiting for the stock price to recover. In the example below, the covered right was buy XYZ at 20, sell January call at 2. While the stock dropped quickly to 16, resulting in XYZ common 16, XYZ January 20 call 0.5, and XYZ January 15 call 2.5. Due to it being unlikely that the stock will recover enough for the original position to be profitable, it is still beneficial to roll down. Another option would be to partially roll down the call. By locking in the loss for only part of the call, you allow yourself to partially mitigate the losses without removing the possibility of profits from underlying stock prices recovering. When rolling down, you may also utilize different expiration series. Advantages of this include a more distant expiration series, which would increase the points of protection received. Disadvantages are that you are locking down a smaller maximum profit for a longer period of time. This is typically done when the rider has grown concerned over the stock's ability to hold current price levels. There are several options for the covered rider when the underlying stock rises in price. They could do nothing and let the stock be called away, which would produce a return they hoped for. If the increase in stock price is not expected to be sustained, the rider could either close the position early or roll the call up. For example, if someone establishes a covered writing position by buying stock at 50 and selling a 6-month call for 6 points, maximum profit potential is 6 points anywhere above 50 at expiration. Downside break even is 44. Suppose the stock rises to 60 in a short period of time. The rider may consider buying back the call that was originally written and rolling up the caller with a high striking price. If the rider were to roll up by buying the July 50 and sell the July 60, they would be increasing the potential profit. If the underlying is above 60 and were called, he would gain 6 points from the July 50 plus 7 points from the July 60, subtracting the 11 points paid to buy back the July 50. Their option profits would be 2 points, adding to the stock profit of 10 points. Maximum potential would be 12 points above 60 at July expiration. This would also increase the break-even point. When run rolls up, a debit is incurred, meaning the investor must deposit additional cash into the covered writing positions. The debit is represented by the increase in the break-even. Due to this debit, many investors are turned off to the aspects of rolling up. Sometimes you would be able to reduce the debit required by rolling to a more distant expiration. Rolling up increases your potential profit, but also exposes one to more risk. Due to this, it is recommended that one should not roll up if they cannot withstand at least a 10% correction of the stock price. There are some common mistakes with rolling up. First, buying back all of the calls for a large debit. This leaves the entire stock holding exposed to downside movements after it has risen dramatically in price, and they amassed a fairly large series of debits. The increase in debits would raise the break-even point. 2. Selling some of out-of-the-money naked puts to bring in credits to reduce the cost of rolling the calls up for debit. This is worse because the entire position is now leveraged tremendously, and a sharp drop in price may incur large losses. To avoid this, allow some positions to be called away at some point and use the funds to establish a new position or try another strategy. Another strategy would be the partial extraction strategy. This strategy applies if the stock has advanced and is in danger of being called away. If the writer does not want to be assigned, a portion of the underlying stock is sold. The proceeds are then used to buy back written calls. A new call option with a higher strike price can be written if desired. In this example, an investor wrote February 45 calls against his XYZ stock. The stock has a very low cost basis because it was purchased long ago, so the writer would not like to be assigned, for that would create a large tax burden. On the other hand, he is not particularly happy to pay a large debit to buy the calls back. Suppose that his position is long 3000 XYZ, currently trading at 50, short 30 February 45 calls, currently trading at 5. The investor could do the following. Buy back 30 February 45 calls at $5, costing $15,000. Sell 300 shares of XYZ stock at 50, bringing in proceeds of $15,000. The net cost for this unwind part of the covered right is zero. They are left with 2,700 shares that are no longer encumbered and can decide if they want to sell calls against these shares or not. Action to take at or near expiration. As expiration nears and time value premium disappears from a written call, the writer may opt to roll forward. To do this, they would buy back a currently written call and sell a longer-term call with the same striking price. Rolling forward for in the money. The optimum time to roll forward for an in the money call is typically when the time value premium has disappeared from the call. When the option begins to trade at a discount, it may be exercised by the arbitrators. At this time, the writer should roll the in the money call forward. Rolling forward for out of the money. The proper time to roll forward for out-of-the-money calls should be done when the return offered by the near-term option is less than the return offered by the long-term call. Rolling forward for out-of-the-money calls can be difficult to handle, but an analysis can be applied to facilitate a decision. For this example, an investor previously entered a covered writing situation in which he wrote 5 January 30th calls against 500 XYZ common stock. The following prices exist currently, 1 month before expiration. XYZ common stock of $29.50, January 30th call, 0.50, and April 30th call of $2.50. In this situation, the writer can only make 50 cents more of time premium. It is possible that their money could be put to better use by rolling forward to the April 30th call. To present a true comparison, commissions for rolling forward must be subtracted from April 30th's premium. By remaining in the January 30th, the writer can make $250 for the 30 days until expiration with a return of $8.33 per day. The commissions rolling forward would be about $100 since the premium for the April 30th call is $250 per option. The writer would make 5 times $250 minus $100 during the 120-day period until expiration. This would have a return of $9.58 per day. The writer should roll forward at this time. Avoiding the uncovered position. There is a margin rule that the covered writer must be aware of if they consider taking a follow-up action on the day that the written call ceases trading. If another call is sold on that day, the writer will be considered uncovered for margin purposes over the weekend and will be obligated to put forth the collateral for an uncovered options. Often, this is not what the writer intended to do. If one plans to wait for an option to expire totally worthless before writing another call, he must wait until a Monday after expiration before writing again to remain covered. When to let stock be called away. Generally, the choice of allowing stock to be called away is the wisest strategy if both of the following criteria are met. 1. Rolling forward only offers a minimal return. 2. Rolling up and forward significantly raises the break-even point and leaves the position relatively unprotected should the stock price drop.
Now we'll be going over the second part of this presentation, which is a simplified guide on how to successfully write covered calls. Quick review of what we've discussed over the majority of this presentation is that when you're writing a covered call, you're selling someone else the right to purchase a stock you already own at a specific price within a specific time frame. A single option usually represents 100 shares, meaning that you should own 100 shares for every contract you plan to sell. Let's go over some considerations that you should keep in mind when writing your covered call. First, you'll pocket the premium right off the bat. Second, the goal of most investors is that they're usually hoping to keep the shares of underlying stock while generating extra income. Understand that you have a risk of losing your shares if the stock performs well and your shares are called away. To prevent this, you should try to keep the price below the strike price. The option buyer won't be motivated to exercise the option and grab your shares away from you. In the worst case scenario, your options will expire worthless and you still get to keep the option premium and your shares of underlying stock. You just miss out on those extra profits. Now your max loss is your stock entry price minus 0 plus your option premium received, and your max gain is the strike price minus the stock entry price plus the option premium received. Your max loss will occur when the stock goes to 0, and your max gain is when you can only profit on the stock up to the strike price of the options contract you sold. Keep in mind that you will have to pay commissions, and that commission can eat away at your profits from the premium received. So investors should see if the premium is high enough to offset that commission cost and make it worth it to write the covered call. Also, keep a wary eye on high returns. Ask yourself why they're priced so high. Is this normal for the stock? Is there any sort of recent news announcement that you've missed? Be careful and research why the price is so high so you don't make incorrect assumptions when deciding whether or not to write the call, assuming that it may be more successful than it actually is. Now, when writing your covered call, you should also understand your risks. The downside risk as a stockholder, since when writing a covered call, you still remain that stockholder position. Let's say the value of your underlying shares falls significantly. Your loss on holding the stock may outweigh gain for the premium received. There's also limited upside risk as a stockholder. Before the sale of the covered call, the stockholder has unlimited potential upside. After writing the covered call, that gain is limited. I've created a simple list of rules to follow to make a successful covered call, and we're going to go over them. The first one is to choose a stock that has already performed well. You want to try to choose a stock that has historically done well over time, and you don't want to risk it on a new company that typically tends to have large fluctuations in their early years and that has no track record. You should also be wary of picking a stock that has done extremely well, because you may not want to lose your ownership if the stock is called away. The second rule is to avoid choosing a stock that you're very bullish on in the long term, meaning that you won't feel too heartbroken if you have to part with the stock and wind up missing out on further gains. The third is keep volatility in mind, risk versus reward that we've talked about in depth throughout this presentation. Writing covered calls works best on stocks with options that are experiencing medium implied volatility, meaning that it has the ability to move, but it's in somewhat a predictable way. If implied volatility is too low, the option premium you collect will also likely be low. If implied volatility is high, the premiums will also be higher and the greater likelihood for the stock to move significantly in either direction, meaning that there's a higher chance of having your stock called away if the price increases or taking the loss if the stock drops sharply. Remember that stocks are extra volatile just before and after their earnings release dates, and this can skew your assumptions made on your part. You should also stay away from extremely volatile stocks since they do not make the best candidates for covered writing calls. Examples of these extremely volatile stocks are biotech and pharmaceutical companies that tend to cut in half or double overnight. It makes it hard to take advantage of that volatility. Now, rule number 4 is to choose an appropriate strike price that you're comfortable selling the call at. Remember, your goal is to maximize income, but minimize your risk. Normally, the strike price should be out of the money, and the goal is for the stock price to rise further in price before you'll have to part with it. If you believe the stock price is going to drop, but you still want to maintain your stock position for the time being, you can sell an in-the-money call option. The final rule is to choose a stock that will provide an acceptable return. Remember, we talked about the rule of thumb is about 1%, but it may be higher due to your personal preference if you want it to be higher because you're taking on more risk. Now let's go over 2 real-life examples. The first one is Best Buy. It was incorporated in 1966, and it's a provider of technology products, services, and solutions, and it offers items in 6 categories. The first one is consumer electronics, and this covers home theater, home automation, digital imaging, health and fitness, and portable audio. The second category is computing and mobile phones, and that does computing and peripherals, networking, tablets, mobile phones, including related mobile carrier commissions, wearables such as smartwatches, and e-readers. The third category is entertainment, and that's gaming and hardware software, movies, music, technology, toys, and other software. The fourth category is appliances, which is refrigeration, dishwashers, ovens, laundry, coffee makers, and blenders. The fifth category is services, which is consultation, design, delivery, installation, setup, protection plans, repair, technical support, and education classes. And the sixth category is listed as other, and that's your snacks, beverages, and other items. So let's look at Best Buy performing over the last year. You can see that even though there's a slight drop around December, it has remained relatively stable. There's a high price of $84.36 and a low of $47.72. When looking at the stock over many years, you can see that there may be points where the stock has dropped slightly, but overall it's been performing well historically over time. Now, why does it make it a good candidate to write a covered call on? First, let's look at the beta, which is a good indicator of your volatility. If you didn't know already, beta should be measured if it is 1, has the same volatility as the market. If it's below 1, it is less volatile than the market. And if it's over 1, it's more volatile than the market. Now, don't let that scare you. Remember, as we said before, you may want to take on more risk to have higher rewards, which in turn would have more volatility and a higher beta. So for Best Buy, the beta is 1.44, which means that it's more volatile than the market, but this could lead to higher earnings. The company's had previous financial success, which we talked about before. In 2016, there was rumors that Amazon would put Best Buy out of business, but it has successfully countered Amazon and has had high profits since. In 2018 alone, they had $40 billion in profits. Now, the company also offers dividends and has a dividend yield close to 3%. And that would give you the opportunity to make more income on top of the premium or potential income from an increase in stock price. You should also look at recent news of the company, and that will give you a good indicator if you believe that the stock price will increase or decrease in the future when setting up your covered call. For the recent news of Best Buy, it has actually shown an increase in stock price. They just released that there has been a positive profit forecast for the year and a better than expected holiday quarter sales. This caused the stock price to surge 16%, and the cause of that was lowering costs by $225 million in fiscal 2019, which is close to their goal of $600 million in savings by 2021. Now let's look at the second real-life example, which is the United Parcel Service known as UPS. The company was incorporated in 1999, and it is a package delivery company that operates in 3 segments, which is the U.S. domestic package operations, the international package operations, and the supply chain and freight operations. It works with well-known companies like Amazon, and it provides shipment processing, multiple payment options, order and shipment history, and automatic tracking updates. Looking over the last year, it's had a high of $125.07 and a low of $89.89. Same thing with Best Buy. If you look at it over many years, it remains relatively stable, and the company has a long track record of doing very well. Now, why is it a good idea to write a covered call on UPS? The beta that we discussed before with Best Buy is slightly lower. It's 1.14, which makes it less risky, but it still has the opportunity for extra earnings. There's higher profits due to a recent downturn in oil prices, which is a major cost to UPS, and the company also offers dividends. And for recent news, there has been severe weather this year that has caused disappointing second quarter profits, which has caused the shares to decrease by 7%, but UPS still promises a strong end to the year. Personally, I wouldn't consider that to be a deterring factor since we are approaching the summer right now, and cyclically you'll have periods throughout the year of good weather and bad weather, and typically in the summer there's more opportunity for UPS to make a lot of business, so I would expect the stock price to increase. Here's just my works cited on the second half of this presentation. Tim and I hope you really enjoyed listening to our presentation on how to establish covered calls, the tips we provided you, and we hope that you have a better understanding on the risk versus reward that we've stressed so much throughout this presentation, and that you'll be more informed when you decide to personally create your own covered calls in the future. Thank you very much.